So g'day there everybody, thanks a lot for joining me as a Tuesday afternoon market recap. Again today, we have seen the markets collectively pop to the upside. It leaves us in somewhat of a rather tricky predicament. Let me just talk you through what we're seeing on the markets at the moment. Really, since we have come on back down and retested this primary macro bullish trend line, which has been in effect really since the beginning of this bull market expansion in the year 2009. You can see on my screen just here. We have still remained obviously above this trend line. Most recently in the month of December, we sold all the way off into it. It took over, or really the process over about 3 months since we did top on this particular candlestick. And really off from this level down here on the S&P 500 at 2,400, slightly below this area. Really since the turn after Christmas, this market has only really known one direction. That of course has been to the upside. If I change very quickly into the weekly chart, you can see the consecutive series of white candlesticks. I do believe this is, I think, the 6th out of 7 weeks where the market has, again, continued to the upside. It is very close to, of course, 7 out of 7. I believe it's this candlestick just here where technically we did close below the previous week's close. However, we still remained and we still printed that of a white candlestick. So when you put this into perspective, this bounce that we have seen, it has moved quite a distance, and we started to be concerned about the market around this pivot up here. Just really between 2,650 and 2,700 was really this candlestick just here after we saw this first gap where we started to believe, or at least potentially, see that of an exhaustion type of move. And the reason we started to at least think about the market in those types of terms or in that type of framework was because, one, we started to see a bunch of candlesticks continue to develop as the market moved sideways, a bunch of spinning tops and shooting stars and hangman types of candlesticks. And also we were coming back on up to retest this resistance area or old support as new resistance for the first time. Now, really since this candlestick over here, the market really hasn't done a whole lot. And this is not only applicable to the S&P 500, but it's also relevant to the Dow, and of course the NASDAQ too. We more or less moved sideways for 1.5 weeks. We saw a pop. This was towards the back end of January. And again, really into the first 2 sessions in the month of February, we've started to move sideways. And it looks as though, again, either we are setting up that of potentially, right, a bull flag continuation, which appears to have broken out as at the close on Tuesday, or if I zoom in into enough detail, all right, and if I bring in enough data, you can see that we're getting a series of what appears to be that of stair-step continuation types of patterns. Both of these patterns, whether or not you're calling this a bull flag or if you want to call it that of a stair-step consolidation or a continuation pattern, they do of course lead to higher prices. The problem, however, and this is where it comes into that sort of tricky situation which I described a little bit earlier, is that when you pay attention to the resistance areas and when you think about, well, just how far have we gone? Let's just call it 2,350. Here we are, we're printing just shy of 2,750. We've seen quite the bounce. I believe we are within about 6% of the all-time high, taking us back to the month of September and October on the S&P 500. And also when I bring up the simple moving averages, if I can push the right template on my screen, you can see that where we closed today as at Tuesday is right on that sideways moving 200 simple moving average. So we've moved a long distance without any type of pullback. All right, we're coming back up. We're retesting this long-term 200-day simple moving average. When I change into the oscillators, again, when we started to pick up on the, the complacency in the market, the overbought, over extreme sort of levels that we were registering, the stochastics was already extremely overbought. So was the RSI, and the MACD was sort of plateauing on the histogram line. Since then, essentially what we've done is we've begun to set up very short-term divergence, or at least on the stochastics. It's not that prevalent. It really doesn't exist on the MACD. However, what is true, okay, is that we are still relatively overbought, and we've been lingering up here really for about a month now. Now, again, we can continue to remain overbought, but when you mix these oscillators, and again, this is not only applicable or not only relevant to the S&P, it's also relevant to the industrial average, the NASDAQ. I mean, whether or not you want to pay attention to the transportational average or the Russell 2000, all of these markets collectively are extremely overextended and they are overbought. So as I look at these markets and I think about, well, how far have we moved? All right, are we coming back on up, obviously, into that big macro sort of resistance area that did act as support for the majority of 2018? All right, the market being as overextended as what it is, a bunch of exhaustion candlestick signals, all right, and the retest of these long-term simple moving averages, it makes sense to me, even though this has been, again, a prolonged sort of continuation, which really the majority of the gains have already been made through really the first half of January. Right, to me, there is a lot of risk still looking at this market if you did want to jump into, right, the SPYs, or if you wanted to trade the diamonds or the Qs. above these little breakout points. Over the weekend in that pro analysis class, we tried, or at least we started to establish bidirectional trade setups. And really, as this market has continued higher, we've been dragging up this short-term bearish entry. At the moment on the S&P 500, it sits at 2,643. On the Dow Jones Industrial Average, that same trigger that we have brought up over time, and again, we are still net long this market. I haven't even spoken about that, but again, since we came on back down and retested this macro primary bullish trend line, 23,432 on the diamonds, right? If you use the industrial average as the contingency order, 2,525 on the S&P 500, and on the Qs, if you wanted to jump into it in the past, or if you did, it was 6,696. So I will say again, we are still net long this market, all right, since this retracement. But what we have been doing again is dragging up a little bit of a hedge up here, and this is where the current sort of market is, or where that support area, right, will be triggered if in fact we do see a strong reversal. I believe we are still going to print that of a dark candlestick, but at the same time, if this market wants to continue to the upside, really there isn't all that much resistance, okay, above this current level at 2751 on the S&P 500 until more or less we come all the way back and up and retest those late 2018 all-time highs. If you do enter into the market more or less above the break of Tuesday's candlestick, please place a tight stop, below the low of today's candlestick, or depending on how you break down your risk and reward in your trade management, if it allows you to, okay, or if you want to sort of move into smaller position sizes or compared to what you would regularly do, the stop really needs to be placed below this candlestick, and this is dated the 8th of February over here. This was Friday's candlestick from last week. That's where the swing low is. And that is where, of course, if I bring up these exponential moving averages, and if I can zoom on into the detail, you can see that at the moment it's below that 10, but in a couple of days' time, that 20 exponential moving average will be above this little swing low again, dating back to last Friday's candlestick. So as hard as it is at this particular time to really not jump into the market bullish, I understand that is where obviously the market movement is, but having said that, it's really starting to slow, and that's what has me concerned. I think that there's a lot of people, unfortunately, who have missed out on the beginning of this bounce off from the primary bullish macro trend line. Again, if there's anything you can take away from this recording right now, it's that a trend is assumed to be in effect until it gives us definitive signals that it has reversed. And again, this is a textbook example of really the sentiment in the marketplace out there shifting from extreme bullishness into, rather sort of extreme pessimism very, very quickly over the space of about 3 months. But of course, that primary bullish trend line since 2009 holding, and of course, the trend still remaining in effect. Very important lesson that you can take away from it. This at the moment right here is at the close on Tuesday. It's rather immaterial, right? We're trying our best to set up bidirectional trade setups, both bullish and bearish. But again, it's really hard to overcome the simple fact that this market is exceptionally overbought. We're coming back on up into critical areas of resistance, and there is an element, of course, of complacency out there. Now, when I look at a bunch of individual stocks as well, and if you've been listening to this sort of public forum here on YouTube, especially if you've been in pro, all right, you'll understand the power of gaps. And if you have a look at a bunch of these important stocks, there are very pronounced gaps, okay, albeit these are very bullish signals, but generally what happens is these gaps need to close before that legitimate move can continue. And if I just scroll through a couple of these stocks, you've got Apple, as I just showed you. You've got Boeing Airlines with a lower gap down here. Let me skip through Biden. We've got also Caterpillar that we have filled recently, and we have done that over sort of a prolonged period. We've got CVX, which has tried to fill the gap more or less. It has done that. Google has almost done its. We've got IBM still that could come down to 122. Netflix as well that has got gaps all over the place. I mean, it's just the perfect sort of setup for this market, which is interrelated, of course, or it has intermarket, obviously, analysis, not intermarket analysis, but of course the stocks that make up the composition of the index. It really looks as though a bunch of these stocks are going to close their gaps, which doesn't really bode all that well for the market moving forward. So again, just to sum this all up, it's rather tricky at the moment. The good news is that if you have vested positions, historically, these are still making money as the market continues to move higher. But this process just here, or this sort of slowdown, it still has me concerned. It has me very concerned. And the reason why I haven't been essentially pushing through updates is because the market really, it hasn't really moved all that far. I mean, if you pay attention to the candlesticks and the price action, I mean, we've gone more or less nowhere. I mean, yes, technically we are up if you discount or if you take into account, of course, today's candlestick. But even as at the close yesterday, I mean, this market is largely unchanged over the span of about 1.5 weeks. And if you think about the lows that even we priced in on Friday last week, it really takes us back to the highs that we priced in on the 18th of January. So it looks as though this is slowing. We still haven't seen any definitive reversal signals, but the good news for really everyone out there is that this market is slowly clawing back the losses that we have priced in for the fourth quarter of 2018. And I've been saying this for a long time, right? I haven't been calling a market top whatsoever. In fact, we've been really open in our dialogue and our forecast, suggesting that this market is going to take out the all-time highs again and to continue to trend further into 2019. And this is really confirming that analysis that we were speaking about during this entire correction over here. So we're relatively early on in. What you should pay attention to is that rising 50 exponential moving average. Technically speaking, these are still not going to provide support because the market is still range bound. It's still moving sideways. But if in fact we do see the pullback, the critical retest to begin with is the rising 50. But if we crack that, again, what I have suggested over the past number of weeks will set up something like this, okay? The pullback into a deeper area, which will then set up that first consecutive, all right, higher low relative to where we were in the month of December, which will then be, all right, a really nice location, X marks the spot, to jump into the market, all right, with larger positions and at a better risk and reward ratio. At the moment, you have to understand this market is overextended. And although we haven't seen any material sort of pullback, again, not suggesting this is going to be a larger bearish continuation. No. This is just going to be the natural ebbs and flows prior to the push higher. But until that happens, and as we push on up into these extremes, there does come, of course, additional risk. And I want you to be aware of that. If you're complacent out there and you're just buying the market where it stands or buying individual stocks and not really registering some of those lower gaps that have really sort of set up really quite nicely over earnings season and throughout earnings season, there is just quite a high element of risk right now. It is higher than what it has been. And I think it's going to potentially catch a lot of people out, those who do not understand it, do not recognize it, and who are succumbing really to the fear of missing out really of this continuation higher. All right, I think we are still going to have a better time to buy this market. However, do as you please, all right? It's really up to you. You make your own decisions. But these are some of the thoughts that I've been sort of contending with or thinking through over the past week, 2 weeks, 3 weeks since this period over here. And still yet to see it. But the good news, if you've got vested positions, you're still making some pretty decent cash, all right? Especially if you've got options on the SPYs, on the Qs, or on the diamonds, okay? So that's going to do us as at this Tuesday afternoon market recap. If you have any questions, email me, success@pivotpoint-trading.com. I'll do my best to talk through this market a little bit more. Just really, I want you to understand that this isn't all that exciting, this little period just here, if you understand the risks and what we've been speaking about over the past number of weeks. So time will tell what's going to happen. But of course, tighten your stops if you're long. And also, if you're going to take new long positions, make sure you place a stop, all right, at the appropriate area based on your risk management and also trade management of the position that you are looking to enter. All right, everybody, it's James signing off on behalf of Pivot Point Trading. All the best. Farewell.